Hello, everyone. This is Diane Rosso and Joe LaValle with Tips on Pips, back with rule number 7. Hey, Joe.
Hi, everyone.
So, we've got this concept of selling markets with the greatest momentum, buying markets with the greatest momentum. What does that mean, and how do we do that?
What it's talking about is you want to sell markets that look the weakest, and you want to buy markets that look the strongest. The problem with that is it's hard to do, and I think the reason for that is because you always think that the market is overdone. It's gone too far in one direction. It's gone too far north, it's gone too far south, and it seems to be safer to trade in the direction opposite the existing trend.
Makes sense.
Well, it does make sense, and I think once again it's part of human nature that it doesn't work in trading. And the reason for that is that if you're taking a look at the, let's say the USD JPY pair we have right here, and if you're looking into a section where it's come down here and it's already moved down a lot and has formed kind of a base and a little bit of a consolidation. A lot of people
Hmm.
would want to take that long because it feels safer to go back where the market has gone before. But if we take a look at this, it went ahead and it moved down a lot further than it did originally. So what it's saying is if you're looking at selling the dollar, you want to look across the pairs that the dollar is organized with and try to pick the weakest one and go with that.
So, if we are really looking for a weak pair, we need to look at the previous decline and see how strong the bear bars are. Would that make sense, Joe?
We do, and we need to compare them against other pairs at the same time. If you take a look at this section over here, and this is the daily chart, by the way,
Hmm.
you can see that there was 3 days that were just pounding down. Day one,
Hmm.
day two, and day three. So what you would do is if you thought that it was a good idea to sell the dollar, you would take a
Hmm.
look at a cross of all the dollar pairs and you try to find the weakest one and go with that. And it's scary, and I guess on the surface it really doesn't make sense because everyone has a problem doing this.
Yeah, I agree. And I think it really makes good sense to not only find the trend, go in the direction of the trend, but also look at the momentum of the bars, Joe. And I think that's what you're saying. Because just because you decide to sell the US dollar against the yen, it may not be the pair with the weakest US dollar. And that's what we're looking out for by studying the momentum in the bars.
Exactly. And the other thing we take a look at a lot of times is a what we call a shelf break, and a lot of people call it a break of resistance, a break of support, those types of
Hmm.
things. And if we look over in this section on the right here, we have a situation where the market was going up and it started to stall again, and then it continued to go up after a break of that area of resistance. So
Hmm.
if you combine these things when you're taking a look at different pairs, you can take a look at it and you can say that this pair looks the strongest in relationship to the dollar, or this pair looks the weakest in relationship to the dollar. And that's usually a good choice. Unfortunately, it tends to be one that's a bit more difficult to make. Basically, what we're talking about is trading back to the reversion of the mean, and I think that a lot of people use a moving average, and that tends to skew things a little bit with the reversion back to the mean when the market can continue to move in the direction of the existing trend. So if you've noticed on our videos here, we keep talking about going with trend, and once again, this is another example of going with trend.
Makes perfect sense. And I love looking at the strength and the momentum of those bars. That wraps up lesson 7. Joe, thanks for your time. See y'all soon.
Talk to everyone later.